Capital with the review of the weekend trading reports for July 21st, 2013. We have a market that's in bullish normal conditions. On an annual basis, we've gone over into overbought territory on weekly RSI 14 at 71 out of 100. On a short-term basis, we're at the upper end of overbought at 98 out of 100 on the 10-day NDX. Price relative to the 200-day moving average has improved to 11.75%, which is green bullish. The slope of the 50 has improved to 0.43%, which is still yellow neutral, but improving. ATR percentage has declined to 0.83%, which is at the low end of normal. The risk index, which is the 30-period moving average of the VIX divided by the 10-period, is in a risk-on condition at 1.16. The z-score value of that reading compared to the last 5,000 days is 1.96 standard deviations, and you can see we've got an extraordinary stretch going on here, looking at the 90-day time series of that indicator. So we're getting up into nosebleed territory in terms of lack of relative volatility. No change to the blended monthly rebalancing portfolios, with the next reevaluation due on or about 1 August. Inside the ETF2 model, the theoretical exposure is at 70%. The model portfolio itself is at 80%. The three leading candidates right now in the 13 ETF are small caps, mid caps, U.S. large caps. About half of the 13 ETF portfolios on cash. Inside the 32 ETF portfolio, again, it's about half and half buy versus cash, and the top three are the Russell 2000 small caps, financials, discretionary, industrials. Interesting that industrials and energy have moved to the top. That's a favorable sign for the U.S. Market going forward. They have been laggards, and when those basic industries and energy coming online, that's very favorable. Looking at the market health check, dark shaded blue area is the river. That's 30-period Bollinger Band plus or minus 1 standard deviation. The lighter blue shaded area is the floodplain, which is the 30-period Bollinger Band plus or minus 2. Thick black line in the middle here is the 30-period regression line with a 1-day lag. The outer channel is formed by the maximum excursion from the regression line during the look-back period, which was this extension down here in a long bottoming tail. We have cleared the 167 and remained above it all week. No resistance overhead. Market at new highs. That very, very favorable. You can see how the slope of the 30-period regression line has crossed the zero line here. It is now positive. That's the slope of this black line. Thick orange ribbon is the 2-period Bollinger Band, which we treat as real price. We've been overbought now on Williams percent R for almost 12 days. You can see the early warning offered by the percent price oscillator. Jaws are still open to the upside, although a little bit of the steam is coming out of it. You can see by the decline here. And that's caused by those 3 or 4 days of consolidation in a row. But the last 2 days, I look at that as failure to fail further, and that was a very favorable closing. ADX remains relatively low at 20. Bulls in charge. That means that another leg up is certainly possible. It could be as much as another $5 or $6. I'm looking at about 175. It would be a natural extension of this leg. Regional report from the ETF2 database. U.S. large caps are stronger than the globals. 54 is better than 48. Inside the U.S., it's small caps at 59, then mid caps at 55, large caps at 54, then tech at 53. Two strongest sectors in the world, U.S. small caps and mid caps. That's part of that risk on condition. two weakest are Latin America at 29 and emerging markets at 37. You can see everything's pretty strong here in the S&P sector spiders, with the strongest being financials, industrials, and discretionary. Looking at the world market model, U.S. is all above average. Anything small cap exceptionally so. Japan above average. China well above average, as is oil. Private equity remains above average. Most of the rest of Asia below average, with Thailand and Indonesia really suffering. They've gone from among the strongest to among the weakest. I would look for a resurgence in them if this strength in the U.S. translates over into the emerging markets. I would look for those two to do well. Everything Europe is above average. Only Austria and Spain are lagging. Inside the business sectors, in every case, the U.S. sector is better or equal to the global counterpart. That continues this trend of the last 4 months. Among the ETF top 30s, little change. Still got banks and clean energy, financial services at the top. Biotech remains strong. Oil has moved its way all the way to the top. These that are green on strength and white on consistency are new strength leaders, if you will. So that's oil, high beta portfolio, small caps. Anything small cap you can see is really moving up. So that's an early risk on leader, and I would stay with those. Looking at the Dow 30 through the same lens, Hewlett-Packard remains at the top of the stack. Small cap dividend is gaining. Not sure how that got into the Dow report. Must have a filter set wrong on that. The weakest, Alcoa and AT&T. You can see Caterpillar starting to move up the list here. Otherwise, the leaders continue to lead. And just for your reference, ETF liquidity. Shifting to the daily report, we've got a number of good channeling and overreaction signals. Triple screen in Hewlett-Packard. AXP, American Express is worth our interest. In the auto framer, got a handful of trades that test out better than 2 to 1, just based on their trade location. Microsoft looks interesting, had an RSI2 value of 1. Was a big loser on Friday and tests out at 4 to 1 on the auto framer. Number 2 on our max pain range compression is both channeling and overreaction. Hewlett-Packard also was a big loser in Techland, a 3 on RSI2. Is a triple screen and a channeling. Inside the ETFs, the VIX at RSI2 value of 8 and 2.5 to 1 on the auto framer. The NASDAQ was part of that little tech weakness on Friday, the Qs, with an RSI2 value of 10 and 2 to 1 on the reward to risk. And in the auto framers, again, you can see all these test out better than 2 to 1 reward to risk. Note the tech again, Microsoft, Intel. You get Caterpillar, American Express. That's a good short list of reasonable candidates for trading. I'll just take a quick look here at the 30-period regression line, and the acceleration factor here is definitely still moving up. The percent stretch is now about 1 standard deviation above the 6-month average, so it's regained its mojo here and is above this consolidation area. And all signs point to up. And I'll just flash through the rest of these just for reference, and you can read them. in the z-scores of the regression line slopes, you can see the 30 and the 10 have both come from below their channel. Now the 10 has come out of the channel and come back, and the 30 is getting ready to leave. So this could be the start of an exceptional move up. This was the last time that the 30 broke above out of its channel, and it gave about an $8 move. So that's why I think another $8 is foreseeable here. And you can see the slope of the 90 has actually started to roll up and is getting stronger again. So this penetration below the river was rejected to the same distance above, and now we'll see if that has legs. If it does have legs, we could see another sequence where we had 1, 2, 3, 4 legs up, and this could be the first leg of what could be some more. So that's things are looking favorable on the long side. Keep your risk measured and your powder dry. This is Ken Long from Tortoise Capital with the review of the weekend trading reports. Cheers.